Hi, Brock VandenBerg, fund manager for TaliMar Income Fund I. Common question that I'm getting from investors is, how will the rate cut by the Fed impact the return of the fund? Well, the answer is it depends. As a mortgage fund, the return to the investor is dependent upon the interest rate that we can charge our borrowers. Currently, the average rate is approximately 10.5%. That rate that we can charge is based upon the availability of capital in the market competing with the types of loans that we fund. Because most of the capital that enters the private debt space is comprised of high net worth investors, family offices, private equity firms, insurance companies, and debt providers, rates are actually impacted by the risk that each of these parties perceive in the market more than they're actually tied to the Fed funds rate. In times of low risk, where home values are stable or increasing, capital enters the market and drives down interest rates. In times of perceived risk, capital exits the market, allowing us to charge higher rates. A good example of this was during COVID. Prior to COVID, the market was flooded with capital, which drove down rates. At the start of COVID, however, capital fled the market, allowing us to charge higher interest rates and therefore resulting in a higher investor return. The same occurred when the Fed started to increase rates and capital stayed on the sideline, cautious about how higher interest rates would impact home values. When the home values continued to increase, capital re-entered the market, again driving down the rates that we could charge. That is why you didn't see investor returns increase at the same level as the Fed funds rate. As I look into the future, I anticipate that we won't see a considerable change in the rates that we can charge for a number of reasons. First, the small and regional banks aren't capitalized well enough to provide the capital our borrowers need to acquire and develop projects. That will lead to higher demand and allow us to maintain rates. Second, a higher level of service to our clients with speed, consistency, and flexibility will allow us to price at a premium. And as the fund grows, we have the ability to fund larger loans where there simply is less competition. As mentioned earlier, the average interest rate of the fund, these are the loans within the fund, is approximately 10.5%, which results in approximately a 9.25% to 9.5% return to the investor. I'm confident that we'll be able to maintain these returns through the end of the year and beat our target return of 9%. I'm also bullish on the residential market long-term in the Southern California market. The demand for housing remains considerably higher than the supply, which should insulate home values from any economic slowdown. If you have any additional questions about the fund, please don't hesitate to reach out to me or my team. If you like this video, please give it a like and don't forget to subscribe to our YouTube channel. Thanks for listening.